Imagine a time before money even existed. No coins, no paper notes, no digital balance glowing on a screen. Trade depended entirely on barter, grain for livestock, tools for textiles. But barter had a serious flaw. It required a double coincidence of wants. If you had wheat but needed shoes, you had to find someone who both needed wheat and had shoes to spare. As societies grew more complex, this system began to collapse under its own limitations, and so humanity made one of its most revolutionary inventions, money. Before we continue the journey, it is important to understand when banking became a formal institution rather than just a practice. The world's first recognized proper bank is widely considered to be the Banca Monte dei Paschi di Siena, established in 1472 in the city of Siena, Italy. Remarkably, it is also the oldest surviving bank in the world. This bank was founded under the authority of the Republic of Siena to provide stable and regulated financial services, especially to support agriculture and local commerce. Unlike earlier temple systems or private moneylenders, this institution had a structured organizational system, government backing and oversight, standardized lending practices, public trust beyond individuals or families. Its original purpose was to offer low-interest loans to the poor, particularly farmers, protecting them from exploitative lenders. This marked a major shift. Banking was no longer just about profit, but also about economic stability and social welfare. The bank introduced more formalized systems of deposits and withdrawals, ledger-based accounting, long-term credit management. It operated continuously through centuries of wars, economic crises, and political change, showing how deeply banking had become embedded in society. This moment represents the transition from early banking practices to true financial institutions, a model that would spread across Europe and eventually the world. Long before coins or banks, ancient civilizations developed what historians call commodity money, objects that had intrinsic value. In places like Mesopotamia, people used barley, silver, and other goods as standardized units of exchange. One of the earliest and most important examples of this was the shekel, recorded as early as around 2150 BCE. Unlike modern money, the shekel was not a coin, but a unit of weight, typically measuring a specific amount of barley or silver, though exact values could vary across regions and time periods. What made the shekel revolutionary was its role as a standard of value. Instead of negotiating the worth of goods each time, people could price items in shekels. For example, a certain amount of barley could equal 1 shekel, labor wages could be defined in shekels, debts and taxes were often calculated using this unit. In agricultural societies, barley was commonly used in everyday transactions, while silver, measured in shekels, served as a more durable and widely accepted store of value for larger or long-distance trade. Even more fascinating is that most shekel-based transactions were not physically exchanged every time. Instead, they were recorded in temple or palace ledgers. A person might owe 10 shekels of silver, but no silver actually handed hands immediately. This was a credit system backed by trust and documentation. This is where something remarkable happened. Money did not begin as physical coins, it began as accounting. In Mesopotamia, accounting was not just simple record-keeping, it was a highly organized system that formed the backbone of the entire economy. Scribes, who were specially trained in writing and mathematics, used cuneiform script on clay tablets to document every financial activity. These tablets recorded deposits of grain or silver into temple storage, loans issued to farmers, traders, and officials, wages paid to workers in standardized units like shekels. taxes and obligations owed to rulers or temples. To ensure accuracy, they developed standardized numerical systems and measurement units. Transactions were often witnessed and sealed, making them legally binding. Some tablets even functioned like receipts, while others resembled contracts specifying repayment dates, interest, and penalties. In many cases, no physical exchange occurred at all. Instead, value was transferred through ledger adjustments. For example, if one merchant owed another 5 shekels, the scribe would simply update the records, reducing one account and increasing the other. This is strikingly similar to how modern banks transfer money digitally today. Even more advanced was the use of tokens and sealed clay envelopes or boule in earlier periods, which represented quantities of goods. These evolved into written records, marking the transition from physical counting to abstract accounting. This system required something far more powerful than coins: institutional trust. People trusted that the records maintained by temples and palaces accurately represented their wealth. In essence, these clay tablets were the world's first bank statements. Mesopotamian societies operated largely on credit systems. Transactions were recorded on clay tablets: who owed what to whom and when it would be repaid. These records formed one of the earliest financial systems in history. At the heart of this system was one of the oldest legal codes ever created, the Code of Hammurabi, established around 1754 BCE by King Hammurabi of Babylon. This code did not merely govern crime and punishment, it laid down detailed financial regulations that resemble early banking laws. It set maximum interest rates, often around 20% for silver and higher for grain loans. It established clear rules for debt repayment. It protected borrowers from excessive exploitation in cases of natural disasters, such as crop failure. It defined collateral agreements, where property or goods could secure a loan, and it specified penalties for failing to honor financial contracts. One remarkable provision stated that if a farmer's crops were destroyed by a storm, they were not required to repay their loan that year, an early example of risk sharing and financial protection. Another law required that all agreements be formally recorded and witnessed, reinforcing the importance of documentation, something that remains central to banking today. In essence, the Code of Hammurabi transformed informal lending into a regulated financial system, introducing accountability, fairness, and legal enforcement. It shows us that even 4,000 years ago, humans understood the importance of controlling debt, interest, and financial trust. In fact, laws like these prove that banking was never just about money. It was about rules, trust, and governance. In essence, the first banking system was not built on coins. It was built on trust, record-keeping, and debt. As wealth accumulated, people needed secure places to store it. Temples in Mesopotamia became the answer. These sacred spaces evolved into the world's first financial institutions. Farmers deposited grain, merchants stored silver, rulers safeguarded treasure. Priests acted as administrators, carefully documenting deposits and loans on clay tablets. But these temples did more than store wealth. They circulated it. They issued loans to traders, financed agriculture, and even charged interest. This was the foundation of banking: deposit, lending, and profit through interest. The system was deeply tied to religion and governance, giving it legitimacy and trust. Here, banking and money were inseparable because money itself existed largely as entries in records rather than physical objects. For centuries, money remained abstract, measured in weights and recorded in ledgers. But around the 7th century BCE, a revolutionary innovation emerged in the Kingdom of Lydia, modern-day Turkey: the first coins. These early coins were made of electrum, a natural alloy of gold and silver, and were stamped with official symbols to guarantee their value. Ancient historians like Herodotus even credited the Lydians as the first people to mint coins for everyday use. This was a turning point. For the first time, money became portable, standardized, and recognized across regions. Coins eliminated the need to weigh metals for every transaction. Trade accelerated, markets expanded, and most importantly, banking systems became more practical and scalable. Coins were not just money, they were trust stamped in metal by authority. With the spread of coinage, financial activity expanded dramatically in ancient Greece and Rome. Private individuals, moneylenders, and bankers emerged in marketplaces. They exchanged foreign currencies, safeguarded deposits, and issued loans with interest. Roman banking became especially advanced. People could maintain accounts, transfer money without physical coins, and even use early forms of checks. This reduced risk and enabled long-distance commerce across the vast Roman Empire. In a sense, Rome reintroduced something ancient Mesopotamia had already mastered: banking without physical money, through account transfers. Between the 7th and 13th centuries, the Islamic world transformed banking into a truly global system. Trade routes stretched across continents, from Spain to India. Merchants needed safer, more efficient financial tools. The solution was the SOC, an early form of the modern check. A SOC was a written financial order instructing a trusted agent or institution to pay a specific amount of money to a named person. Instead of carrying gold or silver across dangerous trade routes, a merchant could deposit funds in one city, such as Baghdad, and receive a SOC document. This document could then be presented in another city, like Cairo or Damascus, where the equivalent amount would be paid out. SOC was an Arabic word which means to seal or lock, and it later gave rise to the term sukuk, the Islamic bonds. What made the SOC system remarkable was its reliance on a network of trust and verification. Financial agents, often connected through merchant families or state-backed institutions, honored these documents across vast distances. Each SOC included details such as the name of the payer and receiver, the exact amount to be transferred, authentication marks or signatures, sometimes witnesses or official seals. This ensured security and minimized fraud. The SOC also functioned as more than just a payment tool. It acted as a credit instrument. Merchants could use it to settle debts, finance trade journeys, or delay payments without moving physical currency. In many ways, it combined the functions of a modern check, bill of exchange, and promissory note. This system significantly reduced the risks of theft, loss, and logistical burden, making long-distance trade faster and safer. It also allowed capital to move efficiently across regions, fueling economic growth. The widespread use and institutional support of SOC were particularly strengthened under the Abbasid Caliphate, especially during the reigns of caliphs like Harun al-Rashid and his son al-Mamun. Their administrations promoted trade, established stable financial networks, and supported commercial laws that allowed instruments like SOC to flourish across cities such as Baghdad, Basra, and Damascus. Importantly, the SOC operated within a broader Islamic financial framework that emphasized contracts, or aqd, trust, amana, and ethical responsibility. This made the system not only practical, but also legally and morally grounded. The word check itself is believed to be derived from SOC, highlighting its lasting influence on modern financial terminology. With a SOC, a trader could deposit money in one city and withdraw it in another, without carrying physical wealth. This reduced theft, increased efficiency, and allowed trade to flourish on an unprecedented scale. This system was supported by strong legal frameworks emphasizing fairness, contracts, and ethical finance. It also introduced sophisticated partnerships and credit systems that resemble modern banking structures. By the 14th century, Europe entered a new phase of financial development. Trade hubs like Florence and Venice became centers of wealth, and banking families rose to dominance. The most famous among them was the Medici family. Their bank, founded in 1397, revolutionized finance by introducing double-entry bookkeeping, a system that recorded both sides of every transaction. This innovation brought clarity, accountability, and precision to financial management, principles that are still used today. But the Medici were not just bankers, they were power brokers. They financed kings, influenced politics, and shaped the course of European history. Banking had evolved from a service into an instrument of economic and political control. By the 17th century, banking took another leap forward with the creation of central banks. Institutions like the Bank of England, founded in 1694, transformed finance by issuing paper money, managing national debt, and regulating currency supply. Paper money marked a profound shift. Unlike coins made of precious metals, its value depended entirely on trust in institutions. Money had come full circle, from abstract accounting in Mesopotamia to physical coins, and back again to trust-based systems. As the centuries progressed, banking continued to evolve alongside technology and globalization. The 19th and 20th centuries saw the rapid expansion of commercial banks, savings institutions, and international financial systems. One of the most revolutionary developments in modern banking was the invention of the automated teller machine, or ATM. The first widely recognized ATM was introduced in 1967 in London by John Shepherd Barron at a branch of Barclays. For the first time, customers could withdraw cash without interacting with a human teller. This innovation transformed banking by providing 24/7 access to money, reducing dependence on physical bank branches, and increasing convenience and speed. Soon after, the introduction of credit cards, debit cards, and electronic fund transfers reshaped how people interacted with money. By the late 19th century and early 21st centuries, banking entered the digital age. Online banking allowed users to manage accounts from home. Mobile apps enabled instant global transactions. Digital wallets and contactless payments reduced the need for cash. Today, banking operates on a global digital network where billions of transactions occur every second. Money is no longer just paper or metal, it's data moving instantly across continents.